Hey, what's up, everybody? Ralph here. So I came across this article on AARP, and it was talking about how there's going to be four big changes coming to both your credit report and credit scoring. Now, for some of you, it's going to affect you in a positive way, and for others, it's going to affect you in a negative way. But regardless if it affects you or not, if you're someone that's managing your money and preparing yourself in a way that's going to help you manage your money properly, then it shouldn't affect you too bad. But for some people, depending on how they're managing their money, some of these changes are going to impact you in a negative or positive light. All right. So going through these changes, the first change is that's going to happen, and this change has already happened. It's I think July 1st is when it's first like getting started, but I think even some of these changes happened like either yesterday or today. But I know they were first being started like come July 1st. That's when these things were going to start taking effect. So the first change was most medical debts are to be removed from credit reports. Right. So starting this summer, basically July 1st. Three main credit bureaus, Equifax, TransUnion, Experian, are implementing a series of changes that will drastically change how medical debt is treated on Americans' credit reports. So among these changes are starting July 1st, paid medical collection debt. Bills that were turned over to collection agencies but were eventually satisfied will no longer appear on a consumer credit report. So if you had a medical debt, right, and it was unpaid and you probably struggled with it, then eventually it got paid, and then now on your it's satisfied. For some people, it just stayed on your credit report. But if you're someone that satisfied that debt, then it's no longer going to appear on your credit report, which is a great thing, right? I think like medical debt shouldn't be appearing on credit reports anyways, because let's say if you're someone that manages their debt properly, you pay all your bills on time, and then an unforeseen emergency happens, and then it's depending on the medical emergency, whether you had like a very tough surgery, and you weren't able to pay it, you struggle to pay. You try to make payments on time, but you probably fell off a few times here and there. The fact that it jumps on your credit report and it like damages your credit, that shouldn't happen, because you're a person that were responsible with your debt, with your bills, and you made sure you paid your bills on time. Then an unforeseen emergency happened, and it got you off track. So the fact that like if you're someone that paid off this debt, this medical debt, it's no longer going to appear on your credit report, which is great, right? So also from July 1st, consumers will get a full year to work out insurance or billing issues from unpaid medical debt that gets reported on credit files. Currently, this grace period is 6 months. In the first half of 2023, the credit bureaus will begin omitting all medical collection debt under 500 from credit reports. So come 2023, if you have a medical debt that's under 500, then they're gonna take it out, which is good. So $500, it shouldn't be, that's something like that, medical debt like that probably shouldn't be appearing on your credit report anyways, but at least you have time now to sort that out. So they're gonna give you a year instead of the 6 months to figure to figure that out, which is great, because obviously emergencies happen, things happen in life, and sometimes it's out of your control. So the fact that they're going to find a way to like work with consumers and try to get this off the report, so at least you can give you a little time, and at least give you a little some help in terms of building your credit, or repairing your credit. That's going to be a big help for a lot of people, because as you can see, like it says, the credit bureaus say these changes will remove roughly 70% of medical collection debt from consumers' credit reports. That's sure to be a welcome relief for tens of millions of Americans who have an estimated $88 billion in medical debt on their ledgers, according to 2022 report. But the thing is, like, that's why it's so important to have an emergency fund, right? So you hear a lot of people talk about this. Like, if you're setting money aside, anywhere from 3 to 6 months, or in some cases, 3 to 12 months, depending on your financial situation. The recommended is 3 to 6 months, but there's some people with 12 months. But if you're someone that's putting money aside, or you have an account where you put money aside just for emergencies, just in case for emergencies, then you don't have to worry so much about having medical debt be a burden to you. Obviously, if you have a big surgery, then it's probably not going to cover, but at least it helps alleviate some of that stress. So that's why if you can at least put some money aside where you're like, oh, hey, if there's an emergency, whether it's your car, a medical emergency, you have money that you can take and use to put at least some money down, so you don't find yourself in a situation like this, right? So the second one is buy now, pay later accounts. So buy now, pay later accounts added to credit files. So a lot of people, it's just going to hurt, right? This is one of the changes that's going to hurt a lot of people, because a lot of people are now using this buy now, pay later in terms of if you're shopping at Walmart, Amazon, what's the other one? Target. So so a lot of people are shopping there and they use these buy now, pay methods where, let's say something costs $200, instead of paying the whole $200 right there, you're gonna break it down in installments. So say 50, so 4 payments of $50, all right? Now, it's almost like a credit card, except that, there's no interest, or, except there's no interest, but, and not only that, it's like the layaway plan, but at least you're getting the item, right away. But for a lot of people, as you'll see as I read through, it's going to affect people's credit. So you got to be careful. You're someone that's shopping using the buy now, pay later. Just understand that it's not meant to help you, right? Obviously, it's meant for the companies, the businesses to make money. So I know a lot of people are using these methods and this payment plan, and for a lot of people, it's going to hurt you, because in the beginning, back then, it never used to appear in your credit report, but now it will. All right, so if you shopped online at places like Amazon, Walmart, Target, you've probably been offered the opportunity to pay your purchase in installments through an emerging credit model called buy now, pay later. All right, customers pay for purchases over several weeks or months, often with no interest. Now, the BNPL option provides people with payment flexibility and the appeal of no finance charges, unlike most credit cards. Nearly 100 million US adults have used BNPL to finance purchase over a past year. That's crazy. I mean, there's over 300 people in the United States, and nearly 100 million are using the buy now, pay later method. I mean, for me, I would never do it, because I'm more, I believe that, obviously, for me, I think the one thing that buy now, pay later method is, one reason why I would never use it, because I don't see no benefit towards it. Like for me, I use credit cards, and I use credit cards responsibly. But the thing is, when I'm using my credit card, now I don't have to pay that credit card. I'm borrowing the bank's money, and the benefit of doing that is there's so much protection. I got protection. I also get rewards. I get cash back. I get flight miles. There's so many benefits to using certain credit cards if you get the right ones. But with the buy now, pay later, there's no benefit other than the fact that you can break it into installments. So for me, I would never use it, because I don't see any financial benefit. At least with my credit cards, I'm getting cash back, I'm getting rewards, and it just also offers me the protection if there's a fraudulent payment transaction, that I can dispute it. So for me, I use credit cards, and a lot of people should, as long as you're using it responsibly, right? So like I said, nearly 100 million US adults have used the buy now, pay later to finance purchase over the past year, according to a TransUnion survey. But buy now, pay later accounts may be classified on your credit report as a short-term loan, and that can lower your score. Now, the reason why it can lower your score is, like, if you understand, when it comes to credit scoring, one of the factors that affect your credit scoring is credit history. The longer your credit history is, the more the more impactful it is on your credit report. Like, credit cards want to see, lenders want to see that you have a long credit history of borrowing money. They want to see that you're responsible. Now, if you say you have like 15, 20 years of credit history, that's going to be good. That's going to be a positive on your credit report. That's going to boost your credit score. The problem with these buy now, pay later methods is that these are short-term loans or short-term financing options. So if you're someone that's always using these buy now, pay later methods, all of these are going to show up on your credit report as, say, a couple months of debt. And that's going to drop down your credit history average. And that's going to thus drop down your score. So if you're someone that's constantly using these buy now, pay later methods, you're going to see that it's going to take a hit on your credit score. So you need to be careful with that if you're someone that's using this method all the time. So if they're going to appear on your credit report, just understand, and you're trying to figure out why your credit score is dropping, then if you're someone that's shopping buy now, pay later, that's going to be a reason why. Right? So you want to be careful with that, because this can be obviously a big, huge impact on your credit score, and this can affect you for obviously future finances, whether you're trying to borrow money for a mortgage or car loan. Although you shouldn't be getting a car loan, you should be buying that cash. But I understand that a lot of people don't have the cash right away to buy the car. But if you're someone that's trying to borrow money, obviously interest rates, I mean, this could affect your interest rate and its overall credit score. So you don't want that. So just make sure to be careful, right? So, and here they explain why. So they say, here's why. The average age of your credit counts as a factor in calculating your FICO score. The gauge of creditworthiness most commonly used by banks and lenders. Each new credit obligation, including the buy now pay later deals, decreases the average age of your credit history. And some people are using buy now pay later repeatedly. The bottom line, even if you pay a buy now pay later account on time, be mindful of the possible hit to your credit score. So like I said, even if you're making your payments on time and then you see your credit score drop, you're like, yo, what happened? The fact that you're someone that uses buy now pay later method, repeatedly, you're gonna see that affects your score negatively. All right. Now the third one, it's so you're gonna get free credit. You're gonna get free credit reports available through the end of 2022. Okay, so the economic fallout from the pandemic wreaked havoc on millions of Americans between job layoffs, business interruptions, and social distancing. The past 2 years have been tough for a lot of people, especially older adults. Early in the pandemic, many lenders and creditors offered more flexibility payment options such as loan deferments, forbearances to people struggling to keep up with their bills. The credit bureaus stepped up too, offering all U.S. adults free weekly credit reports. Pre-pandemic, you could get one free credit report from each bureau per year. Right? So during the pandemic, they were allowing people, they understand that a lot of people were going through a lot of stuff, so they were allowing free credit reports like every month. And like you said, they did it for the past 2 years, but now it's something that they want to make it, to the end of. There was a term, like so they said they offered the offer was supposed to expire April 20th, but they're just going to have it run through, the end of this year. So, but the credit bureaus recently extended until the end of the year through December 31st, so you can continue to request free weekly reports online. So that's something you should be doing anyways. You should be making sure that you're checking your credit report to make sure that everything is going well, that there's nothing suspicious going on there. It's just something you want to get in the habit of. A lot of people, just don't check, and then they find out, when it comes to like buy a house, that they have some identity theft going on, and if they just kept track of it, like at least on a monthly basis or a quarterly basis, they would have been able to pick up on that and then rectify that. So it's just something that you should be doing anyways, and the fact that they're allowing free reports weekly should be a huge benefit to the consumers. So the last one, so they got a new emphasis on trended data. All right, now there are so what they said is there are more than a dozen versions of FICO score. The most recent model, dubbed FICO 10, debuted in January 2020, right before the pandemic. And the thing about these FICOs, there's so many variations of it. Different lenders use different FICO scores. So even if like let's say you have software or whatever, like your credit card, they give you Vantage scoring. Even though you may see a good credit score on there, that may not necessarily be the credit score that your lender is using. Okay, so obviously, like each lender uses different FICO, so you want to make sure that when you're trying to borrow some money for a mortgage, you want to make sure that you know which FICO score that your lender is using. So it says, like its predecessor, FICO 910 takes rental payment history into account. So that's a good thing. So now, like, instead of just mortgages, I think for a lot of people that rent, the fact that you're getting your rent accounted for, and you're showing that you're a responsible renter and you're making payments on time, that should help boost your score. Okay, and it should record that, because obviously, that shows that you're taking responsibility for obviously your housing costs, which is a huge expense for whether you're an owner or a renter. And the fact that they're accounting for that, which is good, right? So equally important, and most closely scrutinized, is trended data evaluating factors like balances and payments over a longer period, 24 months or more, as opposed to looking at one-time snapshot of your debt levels whenever your credit score is pulled. So whenever they look at your credit score, they previously just looked at a year, right? So that whatever you did that year, they would say, okay, this is what you did. But at least for this, new scoring, they're gonna look at 24 months or more. So they're gonna look at your total history of making payments. And if you're someone that's making payments on time, then it's gonna help you out. It's gonna be a good benefit to you. If you're not someone that hasn't made payments and you were irresponsible with your payments, you missed payments, then obviously it's gonna be an issue for you. All right. So FICO 8 and 9 remain the most widely used models. But as more lenders adopt FICO 10, people may see their scores rise or fall based on their debt patterns over many months or even years. Okay, it may not be enough to just pay your bills on time each month to maintain a score of the upper end of FICO's 380 850 range. You'll need to manage debt wisely over time and avoid moves that can lower your score, such as maxing out your credit cards or taking on a bunch of personal loans. Stuff you shouldn't be doing anyways. Obviously, when it comes to credit scoring, like if you're maxing out your credit cards, which is your utilization rate, which is a huge impact on your credit score. If you're doing that, you're going to see your credit score tank. All right. If you have like $1,000 credit limit and you're using $1,000, your credit utilization is going to be 100%, and that's going to tank your credit score. All right. So you want to make sure that you're not maxing out your credit cards and you're not taking out a bunch of personal loans, because then lenders also see that as a risk as why you looking for so much money, why you're looking to acquire so much debt. They may see you as a risk or someone that's that's in money trouble. So you need to be careful when it comes to that. All right. So those are the 4 changes. All right. So you got the 4 changes. So to repeat them again, you got most medical debt will be removed from credit reports. Number 2, you're gonna have the buy now, pay later accounts added to your credit files. Buy now, pay later accounts will be added to your credit reports. And you got free credit reports available through end of 2022. And then the last one is more emphasis on trend data, which is new FICO scoring. So this is important. If you're someone that's struggling with your finances, this is going to have a huge impact on you. If you're someone that uses the buy now, pay later methods, it's going to impact you, in a negative way. So you need to be careful. You need to understand that the way you manage your money, if you're not preparing yourself for situations where, let's say like I said, there's a medical emergency, then you're going to be finding yourself in always financial trouble. So the goal is to make sure you're managing money. You want to make sure you're clearing up debt. You want to make sure you have money aside for emergencies. You want to make sure that you're putting yourself in a position where you're always set financially, and then you're not, when there's trouble, when there's economic issues, that you're not finding yourself stretching yourself thin for money, or you're not dipping into credit cards, you're not dipping into savings, your 401k. You're not scratching and clawing for money. All right. Even if there's bad times, you can make sure you're putting yourself where you're managing your money properly, that you're not stressing yourself out too much. Especially in times like now, where you have inflation and you have so much things going on. Making sure that you're not over leveraged with debt, you'll find yourself better prepared, better, less stressed, able to get through tough times, and that's a good thing, all right? But you see these things, these changes that are coming, it's going to affect a lot of people. And like I said, for the buy now, pay later, so over 100 million people using that. I think for a lot of people, that's going to affect so many people, right? I don't like that buy now, pay later. I don't like that strategy of using money. If you don't have the money to buy that product now, then you shouldn't be making that purchase, right? So, and the same thing with credit cards. If you don't have the money to make that purchase that day, then you shouldn't be using a credit card, right? I use my credit card because I have the money to buy the things that I need, and I use it for reward points. I use it for protection, security. So. Yeah, so these things is something you need to look at, be cognizant of, and make sure that you're managing your money properly to make sure that you're not putting yourself in a position where you're going to be stressed financially. All right, so that's all I got for you guys today. If you found it helpful, make sure to leave a comment down below. If you have any questions, again, leave a comment down below. Hit the like button, share, and please do not forget to subscribe, all right? So you guys take care. Have a good one. Later.